Well, retail sales topping Wall Street's estimates this morning, dismissing some fears of a slowdown in consumer spending, though it's widely expected that the Fed will cut rates for the first time since 2020. Investors continuing to debate how large of a cut the Fed will enact. With more, let's bring in Stephen Juneau. He's the Bank of America's U.S. economist. Stephen, it's great to have you. So let's first zero in on the retail sales print that we got out this morning. Is this likely to change anything for the Fed? Probably not.
Yeah, so we don't think so. I mean, 0.1%, incredibly volatile data always. The consumer shifting spending away from goods anyway. Retail sales is mostly goods when you unpack it. When you look at core control, which is what we focus on more, so that excludes things like autos, it excludes food, it excludes gas and building materials. That actually rose by 0.3% month over month. You're seeing still very solid consumption from the consumer, both on the good side. And when you take into account that 60 to 66%, 2/3 of spending is on services, well, services spending is still holding up too. So I don't think this changes really anything. It's kind of a non-event. And for us, we're still calling for 25 tomorrow. And we're not really changing our view on that on the back of this.
I mean, with this retail sales print, how would you continue to describe the consumer right now, Stephen, knowing the makeup of how consumers are spending, which you were just breaking down, in that over-indexing into services versus goods right now?
Yeah, I mean, I think this is part of a normalization process that we're going through. And we've been seeing this for some time now, where you're finally seeing that spending, that consumer basket really return towards its pre-pandemic basket, where we spend a lot more on services than goods. Obviously, during the pandemic, we couldn't spend on services. So what did we do? We bought a lot more goods. We were at home more. You bought a new TV, you bought a new desk because you were working from home. But now you're seeing that normalization take hold. So for us, a slowing in retail sales, what we're seeing right now, it's not too concerning, right? Overall, when you take a step back, you're still growing on a year-over-year basis. You still have positive job growth, positive wage growth, positive real wage growth on top of that. So that's going to drive overall consumption. And then you layer on the fact that the wealth effect is still positive because financial assets are increasing in price. Well, you've got a good consumer backdrop where you have healthy balance sheets, a lot of income, a lot of wealth. And that's going to really continue to drive the economy and kind of get us that soft landing that we think is very likely.
Stephen, we were taking a look at your colleagues' work earlier this morning, the Bank of America Fund Manager Survey. And what stuck out to us was the findings about soft landing. And this kind of falls into your camp. I'm curious, just with the rising odds, or I guess investors growing a bit more confident that we are going to see a soft landing, your interpretation of the recent economic data that we've gotten, is that consistent with what you're seeing?
Yeah, I think so. I mean, certainly we've seen some cooling in job growth, but 116,000 jobs added over the last 3 months on average is not really typically a worrisome economy. It's not a labor market that's really turning over. We still have significant labor demand. We still have significant consumer demand. We're not really seeing investment slow down sharply. So where's that kind of hard landing coming from? We just don't see it kind of in the data right now. We do see some normalization, we see some cooling, but that's a soft landing, right? So we think that's very consistent with the data. We think the odds of a recession, of a hard landing, are still low. It would still likely require something kind of outside of the US economy, some type of shock to really push the economy into a recession. But when we look at the data, we're not overly concerned about kind of this gradual slowdown. This is ultimately what the Fed wanted to see. This is kind of what we need to see in terms of the labor market to ensure that we're going to get inflation down to 2% over time.
With that in mind, I mean, the characteristics that we've seen of the labor market that the Fed has been paying closest attention to, I mean, it seems like there are, maybe it's just on headline, but maybe it's something that starts to show up in the figures in the future, which is some of the larger companies that are shrinking or reducing some of their workforce or cutting strategically in divisions where there have been big bets. Perhaps they have to pull back on that. There's more scrutiny from investors. Does that start to show up in the numbers, or are these just one-offs and kind of exogenous that are not going to add up to a larger impact here on the employment situation?
Yeah, so you're certainly seeing, if you look at certain industries, manufacturing starting to slow down a little bit. We actually saw kind of about a year or so ago, or in 2023 and this year, we saw kind of certain services sectors, finance, technology, who kind of overhired initially. They've actually pulled back. So their employment's more in line with their recent trend. So we're less worried about kind of a broad-based kind of layoff. What we don't see in the overall economy, the overall labor market, is we don't see a lot of overhiring by businesses, broadly speaking. So there's no need for that to kind of really pull back. So we're going to get these headlines. There's always layoffs. I think that's important to remember. You're going to get these headlines. You're going to get them more and more when people get concerned or when risks are kind of perceived to have risen for a harder landing, because that tells a better story. But right now, when you look at the actual data on the labor market, when you look at hiring, it's not telling you that things are really rolling over right now.
Stephen Juneau, who is the Bank of America Securities U.S. economist. Stephen, thanks so much for taking the time, as always.